what's going on, guys? So if you've ever been caught buying too early or selling too late on DEX 1500 down index, this one video might just change how you trade it forever. Okay, so just stick around, and by the end of it all, you will have a step-by-step approach that you can follow to help you avoid common pitfalls that most people end up falling for with DEX 1500 down. Okay, so the first thing that we're going to focus on is structure. So when we talk about structure, we're mainly focusing on the direction of the trends. Okay, this right here, let's take note of this. Firstly, we have to be in a trending market. Okay, then so we're focusing on the direction of trends and finding the valid entry points. What we're trying to find is a point in price that is valid, or where our negotiations are proper. So these are the points where we can enter our trades, and these entry points are found past the inducement. So our points, the first thing on our list, or the criteria that we'll be using, will be the inducements. It has to be past the inducement no matter what, and it must either touch the fair value gap or the order block, or it might actually touch both. Okay, so we're not going to take them immediately, but rather we're going to scale into a lower time frame to find an entry setup that we're going to take advantage of with, while being in line with the structure on the higher time frame, and we're going to use that to actually enter our trades. Okay, so here's what I mean by all of this. A trending market, let's talk about an uptrend first. A trending market moves like that. If it's an uptrend, okay, we're taking out higher highs and printing higher lows. So this is just a generic way of drawing it, but when you actually want to know the valid levels, the levels, say we're taking out these highs, these highs, using these lows. This low is responsible for taking out this high when it comes up like that. This low is responsible for taking out this high when we come up like that. Okay, so if what we actually mean by inducements, the practical way that the market actually prints price is this way. We go up, we have a bit of some retracement, we go higher, we come back down, we take out this retracement, and we go higher, and we take out that, we'll come back down, and we'll go high, just like that, so on and so forth. Okay, so if we're to label how price actually moves here, we have a low here. Okay, we have a little bit of some retracement there, we have a high right there. Okay, so now price starts to come back down like that. We take out this retracement. So the mistake that most people make is thinking the fact that we've taken out this retracement at a level right there, they think we are changing direction, and they'll be looking to take sell orders at an order block somewhere around there, thinking when they come there they'll short and go lower. But rather, this right here is what we refer to as inducement. So we have to wait for this inducement to be taken out first. Then the level that we're going to print down here is now going to be our higher low. Okay, this higher low, we're going to wait for it to then come up to the upside and take out this level, and we have our break of structure. Okay, so once this low is responsible for taking out this high that is up there, we print a new high there. Remember, on the lower time frame, we've left a bit of a retracement there. So this low that is responsible for taking out this high is our new higher low. This structure won't have to be broken for us to continue our trend to the upside. So once price starts coming back, retracing, remember, while it's retracing, it's not just coming straight down, we're leaving some structure there. This structure that is here will also have to be taken out when we're going to the upside, and this structure is what we refer to as liquidity. Okay, remember, price is only doing either two things. We're either rebalancing, which is us coming back down here, getting to a proper price, then we go up. That's what we're calling rebalancing, us getting to that optimal price trading entry there. Or we are taking out liquidity. While coming down like this, it's taking out the liquidity at this inducement level that's there. While we are going up to take out this level at the top, we're taking out this liquidity and the liquidity that's at the top there. Okay, so once we take out this level and we print a new high there, we then expect price to come back down, take out this inducement that's there, reach an optimal trading price there, and then we continue to the upside. Okay, so when it comes to this optimal trading price, what we are interested in is the fair value gaps and the order block and the inducement. We've spoken about the inducement being taken out right there. Fair value gaps mostly are found somewhere around there. These are just signs that price leaves in order to show that the market is now starting to go in a particular direction with momentum. Okay, then the order block is just the last opposing candle to the direction that we're going to. So since we're talking about the bullish trend, in this last move to the downside here, we'll just take the opposing bearish candle, the candle that says we're going to the downside, and then we'll stretch it out this way, and that will be our order block. Okay, just supply and demand, basic supply and demand. And on levels where we take out this inducement, we hit our order block and we hit our fair value gap, we then scale into a lower time frame. Okay, say we've hit all three of them on this level right there. What we'll then do is scale into our lower time frame. Once we scale into a lower time frame on this level, say the 5 minute or the 15, then say we zoom in, we'll end up finding a similar setup, like something like that. We'll break a level there, broken that level, come back to something similar on the lower time frame, and we'll take our entry there, stops just below the main order block around there, and we'll look to go to the upside. Okay, that is all there is to it when we talk about structure. So please feel free to pause the video and take in what you haven't understood and practice it. Okay, so now we're going to focus on the optimal trading entry. Okay, so optimal trading entry, this is an area. Okay, let's take note of that. It's not really a point or price, but rather an area in which our entry is most likely to yield a risk to reward ratio. Okay, a risk to reward ratio that is more favorable. Okay, so it's more or less like an area. Okay, so an optimal trading entry or area is an area where when we take our trade, say we take a trade with $1 at that particular area, and we have a risk to reward ratio of $4. Okay, of 4, meaning we will yield $4 on every dollar that we trade. If we put in 10, we will pull out 40. If we put 100, we'll pull out 400, so on and so forth. Okay, so the reason why we use an optimal trading area is so that on every trade that we take, we end up with a higher reward, which in time, in the long run, even if our win rate is like 40% and we only get 40 trades right out of 100 that we take, in the long run, we're still going to be profitable, because every single trade that went through, we ended up making 4 times what we risked initially. Okay, so we use different things when trying to find this area. Some examples are the fair value gap, which we spoke about earlier, and another thing is the order block that we also spoke about, and then we also have the Fibonacci, that right there. The Fibonacci mainly is just like, it's a tool that has got like different levels or percentages. Say we have our leg, price is going up, then we have this leg going like that. When we put our Fibonacci tool, all it will do is just give us the percentage of the length of this leg. So we're mainly using this so that we can know what our 50% marker is, and then we will take trades that are in line with anything that is past 50, something like 71, 78, such numbers, because those mean we would get a proper risk to reward ratio. So the Fibonacci isn't what we're going to use. We're not going to use it on its own, but rather we will use it as one of the reasons to actually consider a particular area. Okay, so we're going to use the Fibonacci, the order blocks, and the fair value gaps, and also the one that we spoke earlier about, which is the inducement, or you will see me representing it as IDM on the charts sometimes. Okay, feel free to pause the videos. Okay, pause the videos and read through parts that you haven't understood and play them back. Okay, so here are some examples of trades that were executed based on the information provided in this particular video. Wait a minute, guys. If you have found any of this information helpful in any way, please consider leaving a like down below, leave a comment, subscribe, anything, guys. It would all go a long way.